think we are live. Guys, we are live. FOMC day, and it's a huge FOMC day. This one is like no other. This is the most important FOMC day I have seen and I have covered since my time investing. And not only is it the most important one because it could be signaling a U-turn, but also it's the most confusing one. If you haven't caught up on my video earlier today, the long and short of it is the expectations aren't as clear as you may believe. We're going to quickly go through that. We've got 9 minutes until the interest rate decision. We'll cover that off. We'll then see how markets respond. And then 30 minutes after that, we get the press conference, okay? So at half past the hour, depending on which country you're in, we will then get Jerome Powell with his press conference, and that's going to be really, really important as well. You can see leading up to the FOMC, we saw a breakout from Bitcoin. I tweeted to say, guys, we are breaking up, but watch out for the divergence. Watch out for the RSI divergence. If you're unclear on what divergence is, I've pinned the comment at the top, right at the top of the comment section, ijaz.uk/TA. You're going to learn this stuff for free, guys. Take advantage of it so you do not get caught out with this. Now, if you guys are trading, I use BYBIT, I use BitGet, links are in the description as well. But be very careful. The most painful time you can trade is in between the gap. So when you get the interest rate decision, which is in 9 minutes, trading between that and the press conference is the most dangerous, because what happens is you move a direction, and then when Jerome Powell starts speaking, it throws it another way. So be very, very careful. And we are getting this retest. Now, the key thing for us to look at is it enough for us to do this once the data comes out? And there's going to be a lot of volatility, a lot of traders, a lot of volatility. Let's quickly break down the expectations, okay? Let's see who we've got in here as well, by the way. Smash up the likes, guys, as always. I'm going to test out the TV to make sure you guys can hear that all okay as well. Good to see so many familiar faces on such an important day. Really, really good. Brandon, good to see you. Dr. Quiff, good to see you. Mike, good to see you. Damien, Ultimate Chicken, good to see you. Stanton, good to see you. Stadio, so many familiar faces. Awesome. Don't forget to smash up the likes, guys, and the new faces as well. Please do smash up the likes. Don't forget to subscribe as well. And the market is pricing in 25 basis points, right? The market is basically saying to the Fed, we're going to let you have one more. You can go ahead, you can have one more rate hike. And the question is the Fed going to opt for it? And here's where things get a bit difficult. Because normally, if you had a lower rate hike, if you had this pause here, which 14% of the market has been pricing in, and this has got less and less over the last week, you would have thought that led to the market rallying, right? A pause is good. We've been waiting for a pause. But you got to remember, traditional finance is not going to be happy with a pause because they're going to read a lot into it and say, oh, what have you broken? Why are you pausing? What's going on? The bank's in big problems? So don't be surprised to see the S&P fall on that kind of a news, okay? So you're seeing S&P on the right-hand side here rallying into the news. You can see it. This is the 5-minute chart. On the left-hand side, I'm keeping Bitcoin so we can monitor both together here on the 5-minute and the 1-minute chart. I'll put up the 1 minute from time to time. So don't be surprised to see a little bit of decoupling, because if we get a surprise pause, S&P might hate that because they're like, oh, what's going on with our banks? Remember, there's some banks and other big institutions in the S&P as well. But crypto will be like, the banks are screwed. We're going to rally, and people flock across to Bitcoin. So we will be looking at both of those. It's going to be a very interesting narrative because normally a pause would be good for S&P, good for the NASDAQ, good for Bitcoin, but this could be confusing. Now, nobody's talking about 50 base points. If we get a surprise 50 base points, which rightfully so the market isn't talking about, that could really, really scare the markets. Do not be surprised to see this really collapsing, and that could be a pain. Either way, Jerome Powell is stuck in a very tricky situation. I can see Bitcoin rallying on all the different permutations of the news. Bitcoin can take all of this positively. And that's why it's so crazy. I can't sit here and predict it for you for once. Normally, it's very straightforward. You know what you're going to get. You know which way the market's going to move if you go this direction. This time, it's a lot more confusing because it's going to come down to the nuances, right? In fact, let's see. We've got a couple of minutes here. I'm quickly going to try to now swing across to this. Let's see if I can swing across to my summary of economic projections. Awesome. Hopefully you guys can see that. Perfect. You guys have got that there. So what you can see here, guys, is I've done the summary of economic projections. On the summary of economic projections, I said that don't be surprised to look at this real change in GDP. We need to see, do they notch down the GDP from 1.6 and go lower? Do they change the unemployment rate and knock that up a little bit? And also, what do they do to the Fed funds rate? Will they change this year's Fed funds rate? Because currently they said 5.1. Will they increase that to 5.3, which is saying, oh, we're going to hike more than you thought? Will they decrease it to something like 4.8, which is to say, oh, we may price in one cut as well somewhere in the year? Or will they do otherwise? That's what we need to look at. And also, what do they project for the next 2 years, which is 2024 and 2025? So we will look at that as well. But ultimately, it's going to come down to the press conference as well, where Jerome Powell we'll have to stomach what the main thing is, and we're going to have to judge what he says. How does he talk about the economy? Is he dovish? Is he hawkish? We're going to have to get into all that nitty-gritty as well. Cool. If you guys have any questions, drop them in the chat. I also want to see what are your expectations, because this one's very confusing, guys. I do want to see your expectations, but this could signal a really positive move for crypto, right? It really could trigger us to have a really positive move here on crypto. Shoaib Salam, good to see you as well. Yes, Ramadan starts tonight. Ramadan Mubarak to everybody celebrating. Leica, Yo Ijaz, Mittel, hey, good to see you. JH, good to see you. Kuna, good to see you. Special K, Sylvain. Right, let's test to see if my little television is working. Gotta make sure television is working. So let's pop that there.
Him today, of course. He's decided to take this week off of all weeks. TK's going to be back with us next week. We do miss him, of course. The more I say it, the more people will believe me, right? We miss it.
Just keep going again and again. All right, let's move on.
No, Rich, I'll get to the question. The question that Tom would often ask is why there isn't any dissent on the committee. Is today the kind of day where you'd expect someone to put their hand up, Rich, and just say, I don't see it this way. We need to pause.
Cool. I'm assuming you guys can hear that nice and clearly. Very good. So now let's jump back on to take a look at a few different things. And what I would firstly want to look at is the setup here on Bitcoin, right? If you're looking at here on the daily chart, Bitcoin, given the right scenario, has got every path now to run up towards that 32 range, right? We can. This is where the cluster resistance starts from. It starts from about 28 where we're at right now, all the way up to 30, 32 here. So I expect a nice move upwards if we get the situation that we want. Now, like I said, the situation that we want is pretty much any situation, right? As long as the market see it positively for Bitcoin, if we see a pause, brilliant, we're heading for a U-turn. If we see probably the only bad news for Bitcoin is somehow if Jerome Powell can say, you know what, we're going to carry on with the rate hikes, the banking crisis is fine, don't worry about it, and he actually convinces the market. Like if he can actually convince the market, that's going to be the problem. I tweeted something along those lines. Let me see if I can find it for you guys. I think this is the Jerome Powell we're going to get. This is the Jerome Powell we're going to get, right? If you can't convince them, then confuse them. And if he does that and manages to trick the market that the banks are fine, I'm going to keep bringing inflation down, we're on top of it, yeah, then we could see a bad situation for Bitcoin. Otherwise, even if Bitcoin has 25 basis points, we could see it move. Even if we see 0 basis points, we could see Bitcoin move. And that is the beautiful thing about what we've got today. So we really don't know what the market expectations are and how this is going to move after the decision in 2 minutes. 2 minutes, guys. Everybody's saying you could hear the sound just good. Cool. Drop your expectations. Give me a 0 basis points. Give me a 25 basis points. Do you expect an emergency cut? Let me know. We also do need to take a look at the Fed monitor tool. What you can see is that markets are expecting mainly 25 basis points, and then the next meeting you can then see some are pricing in another 25 basis points thereafter, and others are suggesting a pause there. So you can start to see that markets towards summertime are starting to price in some cuts. So they're pretty much saying we're thereabouts, right? And that's what's exciting, is we're thereabouts. J Hate says we will see 30k plus inside of the next 7 days. Not impossible, guys. 30k within the next. I mean, you can see 30k today with the right conditions, right? That is the importance of today. If we get a pivot, and that's the other thing we quickly need to talk about. I've got about 90 seconds here to talk about this. Is a lot of people are saying that once Jerome Powell pauses, he's definitely going to have to keep reducing rate hikes, right? But there is this other side of Jerome Powell where he's spoken about this a few times at his press conference, where he said he's happy to pause, see what happens, and then hike again. So that's the other thing we have to think about as well. It doesn't necessarily mean that just because he pauses, we're done with this cycle. But the majority of the market is starting to say, if he's going to pause, he's done, right? And that's the other game we've got. What if he pauses but says, I'm really comfortable to hike again at the next meeting? So that's the game we've got to play right now, and I would not want to be Jerome Powell right now. Drop your predictions, guys, and let me know how you playing this. Do you guys have any trades? Are you just holding for the long term? If we get a dip, if there's that surprise situation that we get a dip and we fall towards 25, I made plenty of videos explaining why 25 is absolutely fine for Bitcoin and why I wouldn't have any qualms buying the dip at 25. That'd be a really nice entry point for me, in fact, at around that 25. So let's see if we get that. Someone's just commented there, 50 base points or a pause. Let's see. I'm going to refresh profusely. If you guys get it before me, pop it in the chat, because sometimes this website is awfully slow. I'm going to refresh here on my iPad as well as the PC here. And let's see what we're going to get today. Exciting, exciting. Right, we've switched on the hour according to my clock. Let's see what we got. Pop it in the chat if you guys get it for me. There we go. Statement, PDF. Let's open it. March 22. We got the right date. Where are we going? Where are we going? Always hiked it. He's done 25 basis points, guys. Okay, so first bit done. 25 basis points. Let's see how the market responds. And then also let's see if we can, while we're doing that, if we can get into the summary of economic projections. Perfect. Projection materials. Let's pop this open. Straight away, projection materials. I'm just comparing it to the old one. If you see me looking away here, he's revised GDP down to 1.2. I said 1.3. He's revised that down to 1.2. Unemployment, he popped that to 4.6. Okay, he didn't change that. PCE inflation for 2024, 2.5, kept that the same. Let's look at the Fed funds rate. He popped it down to 4.3. Bullish, guys. Bullish, bullish, bullish. He's saying by the end of 2024, we get to 4.3. That is what we're expecting. But remember that he didn't change this one. This is where he was stubborn. It's good that he didn't increase this to 5.3, but he didn't reduce this. I put on my sheet, remember, that maybe he could lower this down to 4.8. He didn't. So he's sticking to his guns in that, oh, I'm not going to reduce the Fed funds rate. I'm going to keep going. And that's, I think, what the stance may be in half an hour when he speaks. Let's see how the market's responding to this news. Bitcoin is running. I told you Bitcoin's going to run regardless. S&P running. S&P is comfortable now. Because remember, this is on that narrative that, oh, if he did pause, he would have broken something and everyone's going to panic. So I think the S&P is quite comfortable now with that. But again, these are the traders. Let's wait half an hour, deep breath. Right, well, I'm telling myself because I need to take a deep breath. And let's see how this plays out. See, look at that. Look at the trading action going on here. Always chill out. These 5-minute candles are crazy. In fact, let's switch over to 1-minute candles because we're even crazier than that. And because we can. And let that play out while I have a read of your comments. Everybody's saying 25 basis points. They've all got news. Brilliant. Powell speech is important. Definitely. Powell speech now coming in about 25 minutes or so. We'll have that up. Let's see what the initial reaction is here on the news.
3.3% by the end of the year, up 0.2. Core 3.6%, up 0.1. In 2024, slower growth, higher unemployment, and a big drop in inflation to 2.5%. And finally, we should note the statement was unanimous, guys.
Mike McKee, thanks for that. We'll come back to you in just a moment. Let's work through the price action on the S&P 500 positive by 0.25%. On the Nasdaq up by about 0.7%.
Don't worry about what's going on right now, guys. It's more about the longer term. Let half an hour go. Let the press conference come. Let's see what Jerome Powell says.
1%.
We'll take another look at the summary of economic projections as well. Let's pop the TV away. They're not really talking about much. I do want to spend a little bit more time with you guys in the summary of economic projections, just to emphasize what we've done. They've reduced the GDP figure, right? So this will sit for 2024. So they reduced 2023 from 0.5 to 0.4. They reduced 2024 from 1.6 to 1.2. That was bigger than I expected. I expect them to notch that down. They've notched it down a lot more than I thought. You can see that there. You can see that the unemployment rate, they've not really changed that. If anything, they've reduced it for 2023, showing that labor market is still tight, but they think they'll get to 4.6 next year. If you look at PCE inflation, they've popped that up a little bit this year and they've kept it the same for next year. If you look at core PCE, they've popped that up a little bit and they popped it up a little bit for the year afterwards, which is 2024. And this is the key, right? They kept this the same. They said, we're going to carry on. And this is interesting because it's showing that they're not panicking. They're trying to show that, you know, this banking stuff is nothing. Don't worry about it, guys. We're not going to suddenly start cutting this year because the market was pricing in that they're going to cut. That's what the market priced in, right? The market was saying, oh, by summer, you're going to cut. Don't worry about it. They're not showing any cuts here, okay? So they're still showing that we're going to get to 5.1. Keep in mind, we're now at 4.75 to 5, which gives you another half a basis point really hike. One full one. Up towards 5 and then a half on top of that. Okay, so at least 1 basis point, at least one more 25 basis point rate hike is probably going to be priced in by what the Fed are saying here. Interesting that they didn't panic. Interesting that they didn't pause. Maybe that means the data on their side is a little bit better, but they have sped up the cut here in 2024 only by 1 more cut. So they priced in 1 more 25 basis points. I thought they could have been a lot more aggressive here. I thought they really could have started bringing this down a little bit more. I mean, you saw that they've changed that one, and then we want to see what do they do on this one, okay? So we want to take a look at that. Nuno Mocho said, I just want to correct something, guys. I just misspoken on this bit here. So they've increased the Fed funds rate from 4.1 here to 4.3. So they're showing a slower rate hike here, slower cut here than we previously thought, right? Because they were first saying we're going to be at 5.1, and then by 2024, we'll bring it down in the fourth quarter to 4.1. Now they're saying we're still going to be at 5.1. We're going to stay there for longer. Very interesting. I want to see what does Jerome Powell say. How is he fronting this? The market could take quite negatively to this bit. So we need to keep an eye on that bit here. Bitcoin sitting at 28.7, trying to knock on the door 28.8, which we know is quite an important level. SPY now knocking on 400, breaking through 400 right now here on the minute chart. Very nice. Let's see what you guys are saying. Junebug says, yeah, JP loves to throw a dovish, hawkish speech, always sitting on the fence. And so far, looking at what we got, he's trying to confuse us, right? Reduce the GDP, increase the Fed funds rate there in 2024. Very interesting. I do want to, I'm looking forward to this press conference to see what is he saying. Shoaib saying Powell's speech is important. Yep, for sure. Nuno said UK had inflation rise today. Yes, they had a horrible back in the 10s, so it was falling for 3 months in the UK and then it rise back up. Maybe that's what the Fed's worried about as well. Europe have said we need to stay strong on inflation as well. Guys, don't forget to smash up the likes if you appreciate me jumping on here for probably not the most exciting topic outside of our world. But we need to cover it because this is what's impacting your money, and people don't understand this stuff. They don't understand liquidity, they don't understand the markets, and they don't understand this is what's pumping your bags. This is what's moving your investments. SPY pushing nicely through here. This is very interesting, guys. Bitcoin getting into 28.9, very nice here on the minute chart. Nice movement. Look at the traders, crazy guys. I miss these days when I was sitting there in investment bank trading. Pop, pop. It was so quick, guys. I mean, they would pay millions and millions just to make sure your fiber optic cable, you were the closest to the exchange, so your order got executed first. Like, all the retail traders had no chance sitting like we're sitting here trading. Like, the machines we had, everything. Bloomberg terminal. Like, even the Bloomberg terminal would have got the 25 basis point announcement probably at least 20, 30 seconds probably before you guys. Like, it's insane. You see, I was refreshing and then it wouldn't come. They just get it, boom, every time. For earnings, for interest rates, everything. Nuts. That's why you don't mess with traditional finance. It's all rigged. Juno says, lots of pain coming. My house just went up 200 euros per month. It's painful, guys. It's painful out there. The markets are feeling it. But we are getting to the end of this rate hike cycle. Don't let them confuse you otherwise. Yes, he's being stubborn with his 25 basis points, but the market let him have that. The market said, you go ahead and do one more 25 basis points. You can maximum have one more after that, but then sort your life out and bring it down. Now, the interesting thing is when people digest this, when they sleep at night, are they going to be frustrated? Because we've heard from the likes of Elon Musk that they should reduce by 100 basis points immediately. We heard from Bill Ackman that they should pause today. We've heard from many major CEOs of companies, heard from the lady from SoFi, head of investments. She said we should pause today, right? So there's so many people out there running companies that said, we are struggling right now. Banks are obviously saying it. Pause. Jerome Powell said, no, not listening to you. So there's going to be more pain out there. And don't be surprised now if we hear more banks coming out and saying we're struggling, more companies coming out and saying we're struggling, right? That's going to continue. Just getting a little bit of rejection. Bitcoin ran all the way to the door of 29,000. Just getting a little bit of cooling off here. Let's head over to the suits and see what they're saying over on
25 basis points. The equity market a bit firmer on the S&P by 0.5%. A rally on the 2-year. The yield curve steepens just a little bit, or rather we take away some inversion. Lisa, right now the 2-year is down by 12 or 13 basis points. The 10-year is down by 8. So that's been driven by the bull steepener, and we've seen that in a big way in the last couple of weeks.
Well, and if we do get more rate cut expectations baked into the market, because we do see rates ending January at 4.2%, right? So this is a far cry from what the projection is of the Fed. I wonder how that changes through the press conference if they start to say, look, we still have a huge inflationary problem.
Sure.
We still could move higher. We don't view this to be that material, but we are cautious and cognizant of the path that we're on.
Alongside us to weigh in, Diane Swunk, Chief Economist at KPMG, Michael Gapin, Head of US Economics at Bank of America. Diane, first to you, your take on this one. What are your thoughts?
I think that the Fed is basically saying we just don't know how much credit tightening is in the pipeline, and we're willing to do whatever is necessary to chill the economy. We just don't want to send it into a deep freeze, and that's what you're seeing there. I think the idea that we keep rates higher for longer is important to leave out there, because the Fed doesn't want to look as if it's doing a U-turn quite yet, with inflation still running as hot as it is. That said, I do think there is quite a bit of tightening in the pipeline that will do the heavy lifting for the Fed, and that's yet to be seen. And I agree, it is not easy to quantify. Believe me, we've been trying to, and it is an unknown. And that's what the Fed is struggling the most with at this moment in time.
Michael, your initial read, and especially this idea that they have to not drop their estimates for rates too quickly, but basically it's just a placeholder in terms of higher rates for longer.
That's right. I have a similar read. The dot plot tells you and the statement tells you they do think that they're going to get some additional policy rate tightening out of recent events. How much, they don't know. How much will depend on how successful they are at ring fencing and limiting spread from the current situation. If they're successful, the committee's telling you they have one, maybe two more hikes to go.
You lot are funny. Dex goes, what are you sipping? Cognac. No, man, it's Ramadan. Don't say that's haram. You can't say that. I'm drinking juice, like diluted juice. Got to get all my. I've got all this time now to like get ready for my first fast tomorrow. So if you see my videos lagging from tomorrow, if I'm like speaking really slowly, which maybe some of you want to be honest, because I'm always fast. And then that's because of Ramadan.
We were concerned about whether financial conditions were too easy and easing further. Diane, is that no longer a concern as we see basically an easing implied into markets if you only looked at stocks going up and bond yields going down?
It really isn't the way to look at it right now. I think the important issue is what's going on in the broader financial markets, not just in the U.S., but abroad as well. We've seen.
Give me your bets in the comments, guys. What do you think is going to happen post the press conference? Do you think we're going to keep moving? Do you think we're going to claim 29,000? We just knocked the door on it there. We're just getting rejected a little bit here on the minute chart. Do you think after Jerome Powell we will break 29,000 and work towards 30? Let me know in the comments if you guys think. In fact, can we not do a poll and stuff here? Let's see if we can do a poll while you listen to Bloomberg.
Of employment gains, and that's employment gains in firms with less than 250 employees. Those have driven employment gains and offset layoffs elsewhere, high-profile layoffs in the U.S. economy. That's an important thing to keep in mind, is where you're going to see the credit market tightening and how it affects the economy and how it plays out. It's really going to hit very hard the part of the economy that's held it up and kept it so resilient for so long and kept demand so resilient, which has helped to buoy the inflation numbers as well.
Just to work through some of the statement, guys, and to come back to you, Mike, there is this line in there about additional policy firming may be appropriate. They've dealt with this in a quite elegant way, I think, getting rid of that ongoing increases line and putting that in. It's vague enough for it to mean whatever you want it to mean, I guess. Francis Donald is asking that question, though, over at Manulife. What the heck is policy firming exactly? What are we talking, QT or rate hikes? Mike, how are you interpreting that extra line?
I would interpret that as, the way that I look at the SEPs, the forecast there will assume that they're successful at corralling financial stresses, right? That this is the board saying, what do we think is the modal outlook? The modal outlook, we think we're going to be successful at doing what we need to do. And in that world, additional policy rate firming is one or two more rate hikes. That's the way that I would interpret it. But that's a modal forecast. It doesn't take into account distributions or uncertainty. There's a lot more of that right now. And so I do expect a lot of the message in about 20 minutes to be, well, we'll see. It's going to depend on how things evolve.
Well, let's talk about how the
I don't think people understand what's just happened. Like Jerome Powell. So let's zoom back out a second, right, and understand what's going on here. So why are the banks in trouble? So if you go back all the way to 2021, banks had all this cash. And the reason they had all this cash, let's go back a step before that actually. Banks are in the business of lending money. They don't want to sit on cash. Now what happened is after the pandemic, businesses, individuals were not taking out loans. We saw companies reducing reducing employee headcounts, really tightening in the reins. They were not taking out loans, okay? So banks were sat on loads of cash and they don't want to just sit on cash. So they thought, okay, what do we have to do? And they begrudgingly put it into government bonds. Right? They just put it into government bonds, even though it's rubbish yields and you don't really get crazy money returns on government bonds. They went ahead and did it because they can't have cash sat in the bank account, right? That's not the business they're in. And so what then happened was, now that we've been on the fastest interest rate hike in 40 years, we're now sitting at 4.75 on the lower bound Fed funds rate, 4.75. That leads the yield on a bond to increase. But what does that do to the price of a bond? The price of a bond goes down. It's inversely correlated to the yield. So when the price of a bond goes down, that means these banks, and you can see, by the way, the S&P is falling because they're starting to realize what I'm about to say to you here. And when the price of a bond goes down, you're sat with more unrealized losses on your balance sheet because the bonds you were holding, let's say you held $100 million worth of bonds, are now worth 800K or 900K. Now that isn't a problem until depositors want their money back, until there is a bank run like we saw with Credit Suisse, like we saw with Silvergate, like we saw with Signature. Then it becomes a problem because your assets don't match your liabilities. You are trading insolvent as a business. Now, Of course, in this situation, we know Silicon Valley Bank, the Fed stepped in, provide the BTFP program, and they funded it and whatever. But are they going to keep doing that for all the major banks? Are they going to print infinite money? If they do, they're debasing the US dollar. Fine by us, right? We're holding Bitcoin. We're holding crypto. It's our keys, right? So we're in a good position. That's why Bitcoin can benefit from that. Now, if they don't, what are they going to do? We're going to get more banking collapses, right? Bad for traditional finance. And Bitcoin can decouple and do its thing. And that's what's exciting now is we should be able to now move in either situation. Of course, we want monetary policy to loosen. We want the Fed to start printing money. But either they can loosen the interest rates now, which is good for Bitcoin. He didn't do that. He chose to do 25 basis points. Or he's going to have to save the banks by printing money. So ultimately, all of that, it doesn't matter what they want to call it. They can cut their interest rates. They can call it the BTFP program, where they funded Silicon Valley Bank and the others. But all we know is they unwound half their quantitative tightening that they spent a year tightening, right? From the peak here, tighten, gradually, boom, in 1 week, they just unwound half of their quantitative tightening. Right? So we know the money printers are on. They've said they've got infinite money. They're going to protect these banks. Of course they're going to protect the banks. What are they going to do? Let everybody lose their deposits? No. So instead of everybody losing their deposits today, they rather debase the US dollar and give you your money back. But now it's worth less because they printed more of it, right? So this is what people understand. It's like a slow death versus a fast death. Which would you rather? Do you want to lose your deposit? People are going to go, no, I want my deposit. But all right, you can take 10% of it by debasing the currency, right? And that's why Bitcoin is the only true asset you've got with a fixed supply, immutable, decentralized, all the qualities we take for granted in Bitcoin because we're so focused on other altcoins. You start to realize in this mess of a system why it exists. And now Jerome Powell's just gone and added injury to the wound by those banks who were struggling. He's just increased another 0.25. Do you understand? So if you're sat there and your bank with this gap in your balance sheet because you're sat on all these bonds and Jerome Powell's just gone and kicked his foot in with another 25 basis points, you're thinking, great, now the price of my bond has gone down even more, right? So now I'm even more in the red. I'm even more in the hole in terms of trading insolvent. Crazy. Let's now take a look at the charts. I do want to take a look at the dollar index as well to see how the dollar is responding to this news. And you are seeing the dollar index falling. No surprise. Good for risk on. And now the dollar index is getting checked, right? It's getting checked. It's getting thrown back into its EMA ribbon pattern. Brilliant. Good news. Happy with that. Let's switch back to news, see what they've got over here, what the suits are talking about.
Me on, and yeah, thanks for giving me some time to digest this. I think when I look at the message from the Fed via the SEP and their decision to hike rates, what strikes me is how they have balanced financial stability concerns against concerns about stickier inflation. And the way they've done it is they've told us they're going to hike less, but cut later. Hike less, cut later. That's the way they've decided to balance these two concerns. And that seems like a pretty rational decision. So I think the market should feel comfortable with this. The bond market, of course, is now going to have a very difficult time taking out these rate cuts that are priced in through the balance of this year. I would not expect the market to take those rate cuts out in the near term, and it could very well price in more cuts if the data deteriorate from here.
Well, Matt, let's talk about that. We're data dependent. I hear it all the time. At the start of the year, what happened was exactly what we're talking about. This spread between what the Fed was signaling and what the market was pricing. Market was saying rate cuts, recession's coming. Then the data just pushed the market to reprice, encouraged by the communication from the Federal Reserve. Given what's developed in the last couple of weeks, it's a new risk. It's financial instability. Matt, with that in mind, how sensitive will we be to traditional indicators, CPI, payrolls, when it comes to revising those rate cuts?
Yeah, I mean, I think that investors are going to discount data that looks fine and overweight data that doesn't look fine. And so, ultimately, if you have not an unemployment claims number that prints 200,000, pretty much in line with the recent trends, people will, think, what, that just hasn't felt the impact of what's going to come. Versus if unemployment.
Right, let's leave him there. Let's do a little bit of TA, guys, because I do want to look at some of these key levels for you guys. Natural support here if we do fall to the downside, 25K, right? We don't want to lose 25K. We'd unwind too much of the effort we've put in if we lose 25K. But coming down towards 25K isn't the end of the world, right? Coming down to that 25K level around here where my cursor is not the end of the world. Now, if we bring out the EMA ribbon, you see that the EMA ribbon comes in exactly at 25k as well. So natural level for us to collect some support and bounce from there. Now the other patterns we can start to look at are the other ones that are forming. And the key patterns you could be looking at are first and foremost this ascending broadening wedge. Broke out really nicely, right? Nice breakout here from the ascending broadening wedge. Again, happy for it to have a retest. I don't mind that having a retest. In fact, even if it wants a retest up here at 27,000, it's still better than no retest. At least you're showing some strength in the move by building scaffolding, right? A parabolic move just on its own, it looks powerful, but I much prefer, when it builds some support, turns a level into support and goes back again. Because what that means is if you then have a collapse in another couple of weeks or a month's time, you've created support at 25. You've proven that the price is worth 25. We've already had that battle, guys. Do you really want to go back down there? We won that battle. We claimed 25. That's our safe ground. Like if you're an army and you're in a battle, you create a safe ground. You go for a checkpoint almost. So that's what I want to see here. Happy for us to create a checkpoint somewhere between 25 and 27k, and then we can mount our attack onwards. Now, the RSI is telling me similar, right? The RSI is already in overbought territory, which says we could do with this resetting a little bit. There's no harm in this coming down a little bit, the RSI notch down a little bit, and then we go mount our attack at 30, break through 30 towards 32, and head towards our price target, right? This ascending broadening wedge gives you a price target up in the territory of 33.6, right? So we're starting to see a lot of patterns sharing similar targets with us. If you look at this channel, which we broke out from, this gives you a price target up in the region of 33 as well. We saw from this cluster, there's a cluster resistance between 29 and where? 32, 33. So this is the range where you could expect us to move into. But don't expect this range to get beaten so easily, right? This is tough. This is not easy. We can't just run through this like we have. This was a big gap, so we can fill this gap. This is a tough bit of resistance, and then there's a big gap to get us back into the range of 37. So don't be surprised to see a little battle going on here, but once we clear that, a nice big move up towards 37 is very, very possible here on Bitcoin. I would not rule that out. And from where we're at now, what does that indicate? If you take that from where we're at now, up towards those levels at the bottom of the range here, just touching the 37.8 level, you're looking at a 32% move spot on Bitcoin. Working your way up to 40 then gets you back into the 40% range on spot on Bitcoin. So not too shabby, right? And these are the potential moves that can come. And that's even with us already moving crazily from the bottoms, right? I mean, if you've taken this from the bottom to where we're at now, and you've been in Bitcoin like we've been shouting about this whole time here to start this year, you're up 73%. So by the time you go work yourself to the price target, you're up 100% of your money. By the time you work yourself up towards 37, 130%, and that's how you build your portfolio, just on spot, not trying to time the market, crazy leverage trades, crazy margin trades. You don't need to. You just need to build a good portfolio of projects you build in and don't panic sell. Cool. 8 minutes left, guys, before the press conference. We will be switching over to Jerome Powell and covering off what he says. Dex says freebase the currency. Ian, yes, they don't have a choice. It's rock, paper, scissors. Anything they do to help the banks spike inflation, anything they do to reduce inflation, smash their banks. They're trapped. They're trapped, guys. This and on top of that, they've got the audacity to do Operation Choke Point, right? Let's just go back to my little meme I posted. Let's see if I can find that. On top of that, they got the guts to go and do Operation Choke Point, when in reality, this is them. I'm going to find it for you guys. It's worth it. Watch this. This is them. This is live action of the Fed trying to stop crypto, right? They just end up punching themselves in the face. If it plays, come on, meme. There you go. Just punching themselves in the face. That's what they do. That's what the Fed do. Okay, so let's get back into the charts here. Let's keep an eye on Bitcoin, getting a little bit of a calling off, but it's perfectly fine, sitting at 28.4. It's taken the 25 basis points on the chin. Most of the market expected it. I think the S&P will probably take it a little bit worse, given that the banks could be suffering with another 25 basis points. So it'd be interesting to see what happened. Remember, a lot of people thought we'd get a surprise pause. They weren't pricing it into the markets, but if you spoke to a lot of the top CEOs, and I heard them on CNBC and all these channels and tweeting as well, they really wanted a pause. They want Jerome Powell to be done with this cycle. Okay, somebody just asked about Bitcoin dominance. It's worth spending a minute or so on Bitcoin dominance because it's approaching a very, very important level. So if you remember, these are levels we've had drawn for a very long time here on Bitcoin dominance. And every single time we've respected this 48% mark, we've gone back down and we've respected 39%. Now, Bitcoin dominance has had a crazy move up towards 48% line. Now, if we break this level, do not be surprised to see Bitcoin dominance go work its way towards 52, which is the next level. And that could be an explosive move for Bitcoin, and it'll be Bitcoin-led. Right? Alternatively, if we get rejected from dominance, then expect altcoins to start catching up with Bitcoin because they've not really caught up with Bitcoin, right? Bitcoin's been outperforming here. Now, a lot of people get confused with dominance. They're like, oh no, that means Bitcoin's going to go down. No, Bitcoin can be green if altcoins are more green than Bitcoin. Like if Bitcoin has a 2% day and altcoins are having 10% days on average, you will see this start to fall to the downside back towards 39, right? That's what we're talking about when dominance is falling. So it doesn't mean that Bitcoin suddenly stopped moving. Bitcoin can continue to move. It can move to 30, 32, 35. But if altcoins are moving faster, that's when you see the dominance go down. Now, I personally think dominance still has a bit more way to go. Just want to straighten my line there. I personally think dominance has a more way to go because this move, you got to understand how it's happening. It's happening with the increase in liquidity, more people flocking to Bitcoin as a safe haven. You don't flock to altcoins as a safe haven. You flock to Bitcoin as a safe haven to protect your fiat. Okay, that's a very important difference, which people aren't talking about. Let me just check the result of the poll. What did you guys say? 54% of you think we will hit 30K today after Jerome Powell talks. Very interesting. We're going to find out in 5 minutes. Stadia says all those banks wanting 0 base points are going to be in trouble. Definitely. They're in big trouble, guys. They will not be happy. Guys, please do smash up the likes. There's a bunch of you in here who are yet to smash up the likes, and it does support me. We're sitting here covering this late in the evening here. We did want to make sure many people as possible see this stream so they can get
they have on the table and how closely they're watching everything, including the Treasury market. We saw the short selling that pushed the Treasury market liquidity way down to March 2020 levels in the wake of recent events, and I think that's very important as well. Also, they're watching their own deposit window. They're watching bank deposits and the deposits at banks, and what does that mean for liquidity in the broader banking system? They're also looking at the international situation. They've always said they're looking at all of these things at once. Looking at all of them at once has taken on a new sort of spectrum for them, and the risks are now much more to the downside. That this is, I agree with you wholeheartedly, a much more disinflationary story off of an inflationary and a sticky inflationary scenario. Going into 2 weeks ago, we had all the data and got even more affirmation that it looked like inflation was getting sticky, and they're going to get another hot number on the PCE index at the end of the month, and I think that's important to keep in mind as well. But all of that is backward looking. When you look forward, you've got to be worried about what you see, and I don't think the horizon is very clear at the moment. It's why I actually think that we saw so many people say, well, maybe they should pause, or maybe they would pause. Almost 50% of your survey people said, well, maybe they will pause, even though we think they're going to go quarter point. And I think that's because of the uncertainty we face right now. And it's really important for the Fed chairman to underscore that he's confident that the inflation will come down. He said that he's willing to take higher unemployment. As Rich put it, well, a 1% increase in the unemployment rate would make it a recession, a very mild recession. What he has to worry about now is a much more uncontrolled rise in unemployment.
Matt, have we just downgraded the economic data as backward-looking and less relevant after basically emphasizing that entirely?
Well, I don't know if we've downgraded the backward-looking data. I think we've upgraded the current data and the forward-looking data.
Check this out, guys. Let's see if I can pull this up for you guys. Look at this. Market volatility is 3 times higher during press conferences held by current chair Jerome Powell than those held by his predecessors. They tend to reverse the market, what does it say? Reverse the market initial reactions to the committee statements. So this is what we're saying, right? We said this earlier. What you tend to see is you see the market have a movement and then it's reversed by the time Jerome Powell speaks. So be very, very cognizant of that because that could have an impact on the markets here today, okay? So we do need to look out for that. And hopefully Jerome Powell doesn't do that today, right? Hopefully we've had a positive reaction here and hopefully he can let us continue to have our positive reaction. So sometimes what you see is a traders trade, and now because Jerome Powell has created this aura around him that every time he speaks, market reverse in the other direction, he creates more volatility when he talks. That's why you're seeing a selling out. So maybe if he can just stay calm, keep it as it is. Look, he made his stance clear, right? His statement made it clear. He changed the wording on the statement. He did 25 base points. He increased the Fed funds rate for next year. He reduced GDP. So, you know, the market's going to take that on board, and they took it on board. They moved green initially on the statement. So let's see if Jerome Powell can not spoil that and let us have it. Let us have a positive day today. Let's see what you guys are saying before we switch over to the conference in 2 minutes. Reckless Danny says banks will not last the next 10 years. Let me guys know what you think of the Balaji situation. Balaji obviously coming out and talking about hyperinflation, Bitcoin to 1 million in 90 days. Do you think it's just sensationalism? What's odd is he's not normally like that. So the only other time he's rung the bell was obviously for the cough. And he said, look, it's going to be a big deal. And he's rung the fire alarm for it. And now he's doing it for Bitcoin. I think we could see a crazy run up on Bitcoin. I think the ingredients are perfectly lining up we are really in a positive situation now compared to where we were just months ago. Right? Just months ago, it could have been a long, drawn, boring out recession where Fed will eventually take control of inflation, drive us into a mini recession, we get back out, eventually they'll pivot, they'll bring rates down, and then Bitcoin would have done better when rates started coming down. But that would have been the long way. Now, because the banks are starting to cause problems, like Bitcoin is enjoying it, even though inflation is sitting at 6%, right? They're going to print and turn the money printers on, even though inflation is at 6%, which is very, very interesting to see. Right, let's get this up here. Ready to go. Chair Powell to speak any moment. Okay, good. Powell is going to have a hard time avoiding giving the press answers to tricky questions today. He's going to have to give a clear direction or risk looking like he doesn't know what he's doing. It's going to be tough for him. That's because our economy is broken and is driven entirely by the Fed policy. Licker says, if Jerome's speech is not positive, he should be fired. Ouch. Ijaz, we need inflation to go down. Here he comes. Look at that walk. Look at the swag.
Raised 25 basis points. Is the chairman of the Federal Reserve.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, let's get to the questions, guys. This is where we can move markets. Let's go.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting.
He's right. Before the banking
we are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening in credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick?
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect? And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real. And that argues for, being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the of the review, is to discover that.
Go to Mike.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, As you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
So guys, what I wanted to say there was that the biggest thing he can do here is try to convince the market that this banking issue is not systemic. And if he does so, that could be good for traditional markets. They'll be like, oh, okay, the banks are okay. But it'd be bad for the Bitcoin narrative. So watch out for that.
As effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios.
The pattern's holding up pretty well there on that triangle, guys. I mean, look, it is breaking back down into it. We haven't lost. We haven't broken down just yet. Let's see how this plays out. If you can shut up, we can hold this pattern, and we've got something to build on because we're still above 28K.
The discount window that's been around a long time. And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is, and we'll also be watching what's happening with inflation. And
crazy to see Phantom still running. Phantom's up 1% today. I don't know how it manages to do it. Bitcoin's down 0.6% today. Phantom is up 1.2. So net, if you look at it as versus the Bitcoin pair, it's up 1.7%. Like the pumpability of this coin, I mean it. Like the pumpability of this coin is ridiculous. Like how it just manages to move on any sign of good news.
With American Banker, I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through.
Okay, so now on the S&P, guys, we are now officially lower than when we started. This is when we started, when the interest rate decision was announced. S&P is now negative. Same for Bitcoin. Okay, Bitcoin, we are down let's take the percentage there. Bitcoin is about down 2% swing here since the decision was made.
To banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Katerina.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest.
Rugging, guys, it's now turned into an absolute rugging. Powers let us down. Now back below 28. We were unable to hold 28K here on Bitcoin. SPY's fallen back below 400. Done exactly what we said. The market ran on the 25 basis points news on the statement. They read the SEP. We were fine with it. He comes out, brings more volatility straight back in. Exactly what we said. In
long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating. But, nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we see.
just letting you know, Janet Yellen, the secretary, is speaking at the same time. It's annoying. I don't know why they schedule at the same time. They do it on purpose so they can hide information. Just had a note here. She said $2.5 billion cost of the FDIC's SVB resolution is only an estimate and the final cost isn't known. So they're probably hiding and masking the final cost. Remember, JP Morgan said that if you apply the leverage ratio of about 21, this could be a $2 trillion stimulus to the economy. Don't let them play this down.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So. But what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Of course they are. Of course they're safe. Of course they're safe. You just print more. We heard from Neil Kashkari. You guys print as much as you need.
Market Watch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. But we, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well. So far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, get inflation, make sure that the inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
He goes, the unemployment figure is highly uncertain. In other words, he just made it up. He just made up a number, 4.6. Let's go with it. Sounds good to me.
Do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's what so we don't know whether that'll happen this time. We don't know. If so, we don't know what.
The S&P is not having this, guys. It's absolutely not having it.
We're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, we've had very strong labor markets.
Stop, man. You're killing Bitcoin as well. 27.4. Thank you.
4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
Good question. Now we're breaking, guys, on Bitcoin.
You know, it's too early to say, really,
Breaking down.
whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. You know, the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions...
Just wondering whether that 26 level I just drawn there, that orange line around 26 can hold a support.
Immediate attention citations at this point?
How many? I don't know. But those are serious. Those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review is going on, and you know, I want to.
26, and I'll probably nibble a little bit, and then 25, I'll buy a bigger chunk. But I want to see it down 26.
Figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, you know, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, you know, what will be the extent of it, and what will be the duration of it, and then, you know, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, you know, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, you know, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and you know, so that's all I have to say. So,
thank you.
Thank you very much.
Jerome Powell, man. Jerome Powell, what are you doing? How did he do that? This was the hardest FOMC meeting I've ever covered. I said it going into it, and you've seen how it plays out, guys. He came out, he delivers a 25 basis point dovish statement, but markets are not happy. I'm going to do a summary video separate. I'll keep it 8 to 9 minutes so you guys can catch up later on in the next hour or so. Just go watch it later on today, and I'll try to summarize what is going on. But long story short, he's crashed this market, he's dropped this market. But will the market over time, now that he stopped, start to take it in and say, hey, it's not that bad, it's 25 basis points, maybe we get another 25 basis points. But there were certain bits where he was putting his foot down, which we need to dive into. And some of those bits in the summary of economic projections weren't great. Some of his verbiage around we're not going to get a cut this year is not great. And that's leaving markets in a bit of a pickle. And, you know, particularly for Bitcoin. Bitcoin going into this, you would be almost dead cert thinking this is going to push through 29, get to 30, right? Especially after the statement, the market was moving, right? Statement came, we ran all the way up here to 28,000, knocking on the door 29,000. And then from when he spoke, we went from 29,000 all the way to the low we just punctuated there at 27, down 2.2% now. But now that he stopped, you're seeing the market start to climb. And this is the ridiculousness of the market, right? It just doesn't make any sense. He's making up numbers. He just said that he's making up numbers. He's plucking out of thin air. He's now saying that, you know, the credit tightening might mean I might need to do less in terms of rates because it's going to tighten the financial conditions for me. It's just a mess. He doesn't know what he's doing. He's waiting for data to come out. The previous meeting, he kept saying disinflation, disinflation, disinflation. We then got horrible numbers, right? A week ago, before the bank started collapsing, he was probably going to do 50 basis points, right? He was probably going to revise up the Fed funds rate, which he's just kept the same at 5.1. So it's all just completely pivoted here over the last 10 days. He's trying to convince markets that these banks are okay. I mean, you know, obviously he has to say that. He has to somehow convince everybody that the bank's okay, their deposits are safe. I mean, the deposits are safe because you're just going to print and look after the deposits. But Bitcoin should be running on this narrative. We surely can't believe that these banks are safe. And even if they are safe, they're only safe because the money printer is on, which is devaluing the US dollar, which we've spoken about. So, you know, I think what was interesting was he did consider the pause. I think that should go a long way. I think the other thing that should go a long way once we actually sleep on it and think about it is the fact that he changed the phrase from ongoing rate hikes, right? He changed that. And we'll have to see how that now plays out. But, you know, it wasn't a great press conference by him. And I said that going into the press conference. For some reason, he likes being a bit of a celebrity. He likes moving the market and providing volatility, like I shared the stat with you. So yeah, that's where I will do a summary, guys. Thank you so much for joining me for a good hour and a half there on FOMC day. Make sure you smash up the likes on the way. I appreciate you guys joining me here, and I will do a summary video, so make sure you check back in later.